Heyo, welcome to What the FICC, everybody. Spencer Israel here with Ian Cully, head of FICC and also our charts. Of course, that's FICC, fixed income, commodities, and currencies. Today, we're focusing on the FI portion and not the K portion. Ian, we got to talk about bonds and rates and yields in the wake of this U.S. debt downgrade. How's that sound?
Yeah, let's do it. Let's do it.
All right. So if you missed it, the news of the week in bond land is that Fitch, one of the three major credit ratings agencies, downgraded the U.S. Credit rating from AAA to AA plus. I'll be honest, those two ratings sound kind of like the same to me. But whatever. And these are the reasons that they cited. I'll read directly from the release. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. In addition, the government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. So they downgraded U.S. debt. This, of course, is not the first time it's happened. This happened once before in 2011. When another ratings agency, S&P Global, did the same exact thing. Now we're just waiting on Moody's and see what this. Maybe in 10 years they'll do this as well. In any case, Ian, what was the market's reaction to this headline?
It was quiet. I mean, market participants have been downgrading U.S. debt for 2 years now. So, I mean, it's just. It really there's little to no reaction at all.
So it's almost like you're like a parent like threatening to put you in timeout when like you're already in your room, right?
Right.
It's like
yeah,
I'm already here. What are you gonna do? Lock me in?
Yeah.
Right.
Like thanks, Captain Obvious. Thanks,
right.
Fitch.
Right. Okay. So so the market didn't react really. Are we to interpret that reaction or lack thereof to mean that this really, frankly, doesn't matter? Is that fair to say? Doesn't matter?
Yes, I think that's fair to say.
Okay.
I don't think it really matters. No, I mean, not I study price. Right. I study like the bond market, and credit ratings, and it really doesn't matter, especially when they come out after what is it? Last year was one of the worst years for the bond market in history, if not the worst.
Yep.
So 6-7 months later, 8 months later, they want to come out and downgrade debt. It's comical. It's comical.
Yep. So of course, it's not like the bond market participants aren't aware of the reasons that Fitch cited. The debt limit standoffs and the complex budgeting and the lack of a long-term fiscal framework. The market's already aware of this. They know.
Yeah.
This isn't new news. So let's look at the charts here. Let's just look at the bond market over the course of different parts of the curve here, if we can, and maybe you can explain to us what's really going on here in the bond market. Not so much this week, but just overall.
Well, I mean, we can start off looking at the yield curve. And I honestly, I don't gather a lot of information from the yield curve. I'm more interested in the price of bonds and yields directly. But the yield curve is still inverted, and it's been inverted for quite a while. And
so this is showing that the 2-year is currently yielding more than the 10-year.
Correct.
And
correct.
It should be the other way around normally.
Yes, normally. Right. But what's interesting, what I do find, interesting in this chart is that we're back down towards levels that we haven't seen since the 1980s, the early 80s. And you can see late 70s, early 80s, the yield curve was inverted for a prolonged period of time. And I think, that's most likely what we're getting into. Looking at the 10-year minus the 3-month, some analysts and economists prefer to look at this measure. It's inverted, as far as the data that I have, going all the way back to, again, to the early 80s, much like the twos, tens. And that's just a scenario that we're in right now. But what's interesting over the past, I want to say few months, first half of this year, is that the middle of the curve is starting to flatten. And this is what we see here in the upper pane. We have the 10s and the 30 spread, which is actually positive, right? So the 30-year yield, the 30 is yielding more than the 10. And then the 530s is getting close as well. So, it actually is, it's about flat. The 5s and 30s flat. And the twos, 2s, 30s, when you get that far out and we're looking at that lower pane, the 2s, 30s, you're really just looking at the 30 in a lot of ways. But still very negative.
So wait, so what does that all mean though, that it's flattening?
It's just an observation. Again, I don't really gather a lot of information from the curve itself.
You're more of a price guy. Yeah.
I'm more of a price guy, but it's interesting to see that, after inverting, the middle of the curve is starting to flatten. The twos and the 3-month and the Fed fund, obviously much higher than the 10s and the 30s further out on the curve. That's still in place. That's still in place. Again, here's the 5s, 10s, 2s, 10s in the middle, and on the lower pane we have that 10 and 3-month, just showing kind of the disparity here in the spreads, as in that middle of the curve, that 5s, 10s is again starting to creep up, is starting to flatten. When we look at yield, Spencer, path of least resistance, it's higher. It's higher. 30-year yield.
Always remember that relationship, right? The relationship between yield and price.
Yeah, absolutely. So as yields rise, bond prices catch lower. That's the whole fixed income aspect of bonds. So they have to balance each other out. So as the 30 years catching higher, let's look at the TLT, long-term treasury bond ETF. It's breaking down. So it's resolving out of this consolidation and catching lower, again, as the 30-year does the exact opposite. So what does well in this environment? What does well when yields are rising? Commodities. Here's an overlay chart of live cattle futures. I love to use this chart just because they move so closely together. I'm not trying to draw some strong comparison between these two individual lines. It's more of just the general environment, rising interest rates. It supports higher prices for commodities and inflationary assets. What's great is looking at the 30-year yield. We looked at this chart earlier on the morning show. Digging in above those former 2018 highs, catching higher. Looks almost exactly like XLE, the energy sector ETF.
That's interesting how though. I wouldn't think that those two would necessarily be, those two markets would be related. But they're correlated, clearly.
Yeah, absolutely. And I think energy in particular, if rates continue to rise, as we look across at the different cyclical sectors, industrials, materials, financials, I think energy is probably going to do the best. I think they're closely tied to interest rates.
Yeah.
And these assets are just going to do really well when inflation remains high. Right? I mean, inflation's still up near this 3% or 2.75% up here.
Right, that's the 10-year break-even inflation rate.
10-year break-even.
That's not inflation, right? That's not what like the CPI would be right now.
No. That's not the CPI number.
Yep.
No, absolutely not. So here, looking at the 10-year break-even, carving out a potential base, yields, carving out potential bases and resolving higher. Do commodities do the same? that's kind of where my head's at right now. That's really, you know, top of mind. You know, are we going to continue to see, you know, these you know, pro-cyclical inflationary assets do well during the second half as the market leaders, as tech and growth hit logical levels of supply and begin to digest those gains and correct. I think that's really that's the story driving markets right now.
So to summarize your take, you don't care about Fitch or any credit ratings agency downgrading or doing anything to their rating to the U.S. Credit, and you don't care because the market showed that it doesn't care. What you're more focused on is the fact that bond yields have continued to rise, and therefore the prices of bonds will fall with that. They're inversely related, and you're bearish for, you know, for the interim. Is that?
I am. I'm definitely bearish bonds. I mean, we've talked about this recently. Yeah, I was joking, you know, the past month or so about sell the two. You know, I think there's a trade there. I'm not crazy about it. I'm actually not crazy about shorting bonds. I just think there's better opportunities out there for you know, systematic traders. I'm sure you can take these signals because, you know, they're flashing. Sell signals are flashing, or they're getting close to triggering. I think across the curve, especially out the 10, the 30. But you know, I'd rather look for areas of strength and catch the rotation in the stock market, because this is, you know, it's a pretty significant strong downtrend in bonds. And, you know, like Jason said last week, he doesn't know how much, you know, downside, you know, is left in this trend, at least in the intermediate term. So I'd rather, you know, switch and look for commodities, specifically energy, because as rates rise, again, those energy names are going to do better. You know, rates fall, it's gold over energy. Rates are on rising, it's energy, it's crude oil over gold. So I think that's the move right now, and you know, looking to energy names to also express that bullish thesis on energy.
Yep. So not so much taking any action in the bond market, but mostly just using the bond market as a signal for what to do with stocks and commodities. So all right, let's keep going here.
So it's interesting to see some of the intermarket ratios and the intermarket relations between those ratios and yields start to click again. They've diverged, and this is a great example. The 10-year yield overlaid with small cap value versus small cap growth. So again, as yields rise, those value-oriented sectors, you know, materials, industrials, financials, energy, tend to outperform, you know, your tech, your communications, the discretionary. But we haven't seen that. We haven't seen that for most of this year. It's been quite the opposite. Yields have remained elevated, and small cap value has underperformed small cap growth. I mean, growth has just been absolutely ripping. Starting to pause. These growth sectors are pausing. Value, that rotation is moving down into value, and yields are beginning to rise. So it really makes sense. And you can see in the lower pane here, we have a 63 period correlation, the 63-day rolling correlation, and it's starting to go positive again. I think that's important. There's a number of other intermarket ratios that I'm monitoring, share with you guys in the future, to see if they're kind of starting to click and get back on the same page. And a lot of divergences or decoupling of common intermarket relationships over the past year with that strong sell-off. So it'll be very interesting to see, you know, value and cyclical areas of the market begin to participate as rates catch higher here.
Okay.
But what's interesting, it's, can't leave the dollar out of the conversation.
The dollar is also a big driver, right? But I know you're looking at the bond market as giving you a signal. The dollar is an equally, if not stronger, signal.
Yeah, what's interesting is it really all comes down to the dollar. A dollar above 101, 101.50. It's stocks at the index level. It's very important. The growth heavy major U.S. stock indexes are probably under pressure. High probability that they're coming under increased selling pressure as the dollar catches above that level. But the chart here I want to share is the U.S. 10-year yield and the U.S. dollar index, DXY, overlaid in a 21-day rolling correlation on the lower pane. And the reason the dollar and yields were the two major headwinds during last year's sell-off in bonds and stocks, right? Both of them caught higher, strong correlation between the two. And now it's starting to kick back in. And that failed breakdown on the dollar, if the dollar continues to rip higher along with yields, it's going to be tough. It's going to be tough for the major indexes. It doesn't necessarily mean there won't be opportunities, again, like in particular commodities, because over the past year and a half or 2 years, commodities really haven't cared that the US dollar has been catching higher. And that had a lot to do with yields rising and inflation rising. So there's just because the dollar's catching higher, you say, oh no, dollar above 101.50, risk assets are no touch. Some risk assets, right? There's still going to be plenty of opportunities beneath the surface, again, in those value-oriented sectors of the market and in the commodity space as well.
Yes. So what you're saying is not one, but two signals flashing caution for the stock market, at least for now.
Yes, for the major indexes, exactly.
Right.
And here's a good representation of what I was talking about. Here's the dollar overlaid with the all country world index ex-US. So this is outside of the US, all of the other just global equities.
That's a funky looking what the heck? What's a funky looking relationship?
Well, it's a strong negative relationship, right? So as the dollar catches higher, global equities do not fare well.
You're right. This is what it is. This is a visual depiction of what an inverse relationship looks like that is incredibly consistent. Wow.
Yeah, it's incredible. And here's when we add the US in. I mean, it's the same story. It's the same story for US equities as well at the index level. And I think that's really important.
Right. Indexes are not stocks, right?
Right. No, it's a market of stocks, not a stock market. Right. I love that. I love what JC.
So Ian's not saying that like the stock, like no stocks are going to go up, in the short to medium term here. He's saying some stocks some stocks will go up, right? But maybe the S&P 500, the Russell, the Dow Jones, the NASDAQ, maybe the major indexes struggle here a little bit. And you have to go under the hood, really under the hood, to find your winners, right?
And that's what we do. That's what's so great is that's exactly what we do. I'm this is a particular area of the stock market that I love to run through. Energy and materials, all those metals and mining stocks and these industrial stocks are looking great too. So that's what we do. That's what we do at All Star Charts. And then, it's also really important, I think, to keep in mind is as rates rise, because I really think we're there, right? I think everyone can agree that the trend is undoubtedly higher for yields right now. So
yeah.
the real question isn't so much are yields going to catch higher. I think it's how do they catch higher? I think that's really important. I don't think the overall market wants to see yields rip like this. I'd much rather prefer a slow, kind of steady grind higher. I think that would be good for stocks in general. Even the more cyclical areas of the market and commodities. I think a slow, steady rise. The 10-year, gradually going up and hitting that 5.25. Maybe Q1 next year. Maybe not, next quarter. Maybe it takes a little longer. I don't think that would be a bad thing.
Sometimes it's good, for markets to take breathers, pause for breath after they've been ripping. I'm talking about the stock market, right? So, yeah, markets can't always go higher. That's kind of the whole point. So, okay. Guys, Ian Cully, head of FICC and All-Star Charts. Ian, where can people find more of your research?
Allstarcharts.com. You can follow along at Ian Cully on Twitter.
Yeah, the link to Ian's blog is in the description below this video. The link to join All-Star Charts and get access to all of Ian's research is also in there. By the way, if you are an All-Star Charts premium member and you email us with a question, and when I say us, I mean you email we can email on the one that's on the screen if you want. There's multiple avenues to do so. But regardless, however you contact us, if you are an All-Star Charts member, a premium member, then we will 100%. And when I say we, I don't mean me, I mean Ian. If you're emailing him, he will 100% respond to your email and answer your question. We get a lot of emails. We can't respond to them all, but we do respond to every single All-Star Charts premium members question. That's kind of one of the things that you get, right? So
I know, actually, we get off this call. I have a couple of emails to catch up on. A lot of questions about natty gas. People getting antsy about natty gas, and it's funny. A close friend of mine reached out a couple weeks ago and wanted to know, like, how long am I in natty gas? And right now, I don't really hold anything, believe it or not. I'm waiting for an upside resolution, but not to get off topic. Sorry there, Spencer.
All right, what should we talk about next week, guys? We do the show every Wednesday, every Friday at 11:30 a.m. Eastern time. If you go back and look at the past couple of our shows, we've talked about we've talked about gold, we've talked about uranium, we've talked about rates, of course, today. We've talked about energy and oil. What specific market in the fixed income, commodities, or currency land do you want us to talk about? With softs, we talked about grains, but we did not talk about softs, Jonathan. So we can definitely
softs were market leaders earlier this year, and they continue to do really well. I mean, cocoa continues to just march higher. We can talk about cocoa.
We can do a show about the softs. We can do a show about the softs. Also, if there's anyone else that you follow and you want us to get them on the show, tell us. Drop their name in the chat. Email us. Say, hey, I'd love for you guys to have this person on or that person on. We'll do our very best to get them on. We do have friends throughout the industry, and we try to have guests every week or so. So let us know who you want to hear from, and we'll do our best to get them on the show. As always, follow Ian on Twitter. His handle is also in the description of this video on YouTube below. And precious metals. We've talked about palladium a bunch, I feel like, but we can definitely do like a precious metals X gold show. I feel
that would be great.
Yeah. Or maybe like X gold, X copper, because we talk about those a lot, I feel like.
Copper's running to a very important level right now. I'll tweet it here in a second.
Yeah.
Right around that 395.
Yeah.
It's trying, folks. It's trying.
All right, Ian, any final thoughts? And then I figure it's Friday. Might as well let the people go. Might as well get out and enjoy ourselves a little bit.
That's right. Enjoy the weekend. Enjoy the sun.
Enjoy the sun. All right, everyone. We'll catch you guys next week. Have a good one.